Well, good morning and welcome to the Small Business Economic Review. I'm Gary Stockton, here to touch on just a couple of items before we get underway. If you would like to follow along or maybe view the slides at your own pace, we've dropped a copy of the PDF in the handouts area, or you can just hit that short link that we have there. We'll also include a link to the slides in our follow-up emails. We've also placed a copy of the just released Main Street report, hot off the press. Contains many of the insights we're going to be talking about today. You can download a copy of the handouts from the handouts area, as I said, and we'll include links in our email, which you should receive tomorrow. Our presenters today are Brodie Oldham and Marsha Silverman. Brodie leads a team of experts who help businesses make sense of complex data. His team analyzes market trends, builds predictive models, and creates clear visualizations that help companies make smarter decisions. He specializes in utilizing data to solve real-world business challenges, from understanding credit risk to spotting new market opportunities. Brodie also shares his insights as a speaker and writer, helping business leaders stay ahead of shifts in the credit markets. And Marsha Silverman is a senior strategic analytic consultant with Experian since 2013. Marsha supports the Commercial Data Science Group and advises on commercial strategies, prospecting, acquisition, account management, and collections. In addition to her over 25 years in financial services, she leads publication of Experian's Commercial Pulse report. She holds a BA in economics from Haverford College and an MBA in finance from NYU. While we're presenting, we would love to receive your questions. Just hit the Q&A applet in the tool panel. We'll answer those at the end if time permits. We've got a lot to cover today, though, so if we don't get time, we will certainly be in touch with you directly with a response. And now I'd like to turn things over to Brodie and Marsha for today's review. Brodie?
All right, thanks, Gary. You know, I am super excited to have an opportunity to meet with you all today. I am not AI generated. I am an actual voice from an actual person. And as we go through some of the insights today, what I want to share with you are some of the changes that we're seeing across the globe that will impact each of you from a lender perspective, an engagement perspective, from your own small business owner perspective. A lot of you have your own small businesses. We'll talk about impacts from what we're seeing across supply chains and from a lending perspective for a small business owner. And we'll look at how our customers are engaging us and how they feel about the economy today. You'll see on this first top story slide that it leans into supply chain pressures. And I think it's across the globe over the past few months, we've had some events that have occurred, flashpoints across the globe, hitting in different areas, both from a Southern Asia perspective into the Strait of Hormuz in the most recent days, and really across the globe as the U.S. interacts with different partners, trading partners, and engages in increasing our ability to generate growth here in the U.S. So I think we see a lot of flashpoints that are happening right now. And as we look at our supply chains from a commercial perspective here in the U.S., there has been a lot of redirection. I think the most recently this week, when we look at the Strait of Hormuz, what we're seeing is, air traffic, our ability to deliver freight across the region has slowed. Our travel to that region has slowed. I mean, when you think about the amount of air freight that's going through the region, about 18% of our air freight overall in the globe is going through that region every day. So it will be impacting the ability for us to get containers in and out, containers from China coming across, containers from that region, and frankly, our products from the U.S. out into the market. And so we will see impacts there as ships are sidelined through this time as they've been targeted through recent events. So we'll see some slowdown, not only with freight, but with energy. And so our supply of natural gas as well as oil coming out of the region will certainly be slowed and even at a standstill for the next about 5 to 7 days is the expectation. It could stretch out a little bit longer, but Marsha is going to talk to some of those impacts on small businesses as we go forward today. But I think it's important to see that it's not only the slowness of our supply chain that may impact us here, but it'll be the cost that we see. So as we look at the cost of our of the parts and pieces that we use here in the U.S. and our delivery, we should see containers, right now as we look at container costs, even through the pandemic, we saw them get up to about $2,000, where we'll and grow even higher. And we saw companies like Walmart purchase planes so that they could fly around products. We already see some hints at containers going up to as much as $5,000 per container, just as a flat fee going forward. That's going to increase some costs here in the U.S. from shipping costs in some of the products that we have and deliveries from international imports as we go forward. So it won't impact small businesses as we get into the next couple months. So we may see some bit of pressure on inflation as we go forward. Some of those things are ones that we can expect anytime we have a conflict in a region. We'll see a spike in those costs as we go forward, as we manage how supply chains will work going forward. And we saw that the U.S. is very resilient in doing that, and that businesses have the ability to transition supply chains as we go forward. As we look at U.S. tariffs, we've had tariff policies that have been, higher than 145%, come down to 15%, down to 10% over the past few weeks, and look at opportunities to pushing back up to 15. When we think about tariffs, we think about you. We think about the small business owner. We think about our customers as a small business lender. And what I really want to see at this point is what you guys think on the phone. We want to keep you engaged during this call. So we're going to bring up our first poll question. Gary, can you bring that up for us and kind of talk about what we're looking at here as far as a tariff policy perspective?
Okay, you should see the poll now.
All right, great. So let's think about how tariffs will impact you in the next few months. How are you seeing your policies changing? And then, Gary, as we take a look at that, let's think about, as we go forward, how the responses are coming in, and Gary, what we're seeing as far as our customers here and their perspective on how tariff changes. So what we've seen from the Supreme Court decision in the past month here, how that's going to impact your business going forward. Are you going to make any changes as far as the way that you engage your customers? Gary, how are we doing?
We've got about 43% voted. This is looking very mixed. If we can get a few more votes in, we get more of a consensus. We've got this cohort that's just waiting to vote, wants to see where it's leaning. I'm going to go ahead and close it, and we'll take a look here and see. But I think it'll be very.
Tell me what we've got, Gary.
Yeah, let's close it and share this. A 22% lower cost of goods, 19% lower customer prices, 14% higher margins with pricing unchanged, 16% increased demand and sales volume, and then 29% minimal, no impact.
So some changes across. I think it's good to see a little bit of a mixed bag. So some of you are interested in returning some of that value to your customers as we see some lower prices across the industry, maybe some relief for customers that have seen higher prices from inflation, and then others keeping that margin at a higher level as we go forward because there's potential for some more volatility, even outside of what we see from a tariff question. So volatility in the markets, volatility in supply chains that may create opportunity for costs to go up and down, and for us as producers to be able to eliminate a lot of that volatility for our end customer, keeping that price stable as we go forward. Well, I think that leads into affordability. And affordability is really the second big story that's out there that'll follow us into the midterms. And what we're seeing in general is the price of goods, rent, food have been coming down. We've seen those inflationary pressures kind of push down as inflation has been slowing a bit. We certainly look for that to, we'd like for it to improve, but we're going to talk about a few things that'll keep that pressure on inflation being a little bit more sticky from a stagflation perspective through the next year. And I think that's something that we should all be looking at and managing as we go forward. Now, you'll see the price of energy here having kind of a downward in January trajectory. That's certainly going to pick back up here as we've looked at oil prices already over $85 a barrel. We see consumption from data centers picking up, certainly as we've seen that increase in data center builds. The draw off of the main grid. The administration came out and talked about policies that would look at those that are the big users, the data center users of energy, supplying some of their own energy as we go forward. So we should see some energy inflation pick back up, put some upward pressure on our affordability overall. And I think that's, from a U.S. perspective, I think consumers will be okay over the next couple weeks, depending on how quickly we can open up again the Strait of Hormuz as we go forward. But I think we're in this kind of space where we've got enough buffer here from a consumer perspective to keep us going, but the length of time that we have where we'll see the pressure and increased prices for consumers, I think that'll be a real challenge for the U.S. consumer. But again, we're in a midterm election cycle. I think there's going to be more appetite for providing additional support to consumers. And we're going to talk about some of that additional support that could be coming. AI adoption is the third big story that's out there. As you can see, subscriptions are certainly picking up. If you're following this story, and we certainly are from an Experian perspective, we see the adoption of generative AI types of tools really picking up and helping from an efficiency perspective across our business here for our own business. And me as a small business owner, so I have a pie shop that's cooking along, and from an AI perspective and a subscription user myself of different AI tools, I can tell you it certainly has helped me in the development of my own small business. And so we see that across, sole props and new small business startups, which Marsha is going to talk about a little bit in the expansion there, the continued expansion of small business starts. AI and these tools, ChatGPT, Microsoft Copilot, all these different types of just interaction tools with LLMs are helping small businesses get a faster start, get more of this under them at a lower cost, and be able to get their business moving. So let's talk about what we would see from an efficiency of some of the larger businesses on the next slide. So as AI adoption continues forward across industries and across the globe, what we'll see is the average impact of AI is really going to pick up next year. So we look at the last 3 years, we've kind of just seen the investment in getting the infrastructure built. Now we're starting to see tools that really help us. And you can see the U.S. is really one of those that's leaning into AI as we go forward. Now, what you'll see also, yeah.
Were we going to do that poll on that last slide, the AI poll?
Yeah, we can do that here in just a second. So,
okay, just wanted to check.
I think when we can jump into that in just a second. So from a global perspective, I'd say the U.S. is certainly leaning into productivity. So let's talk about what you're seeing from a productivity perspective. We're going to open up a poll here. Gary, why don't you kick it off? That's great. I'm glad you prompted again. Let's take a look at what we have from our customer perspective.
You're seeing the responses coming in now, Brodie.
All right.
I can't really live
So
without AI now. I don't know about you, Brodie, but it's just a go-to every day for me.
oh, I think it totally is. And I was sitting on the porch with my mother the other day, and she was beating me to responses, which is fun when you get up into, well, I won't say her age, but as you get as a boomer, a little bit older, and she is really leaning into it too. I think it is definitely a co-pilot for all of us, a ride along that helps us to get the answers more quickly. And I think we can apply that not only in our personal lives, but in the work that we're doing. Those efficiencies grow, and the way that we look at our roles will certainly change. So, Gary,
Yeah.
how are we on our poll?
Well, we got about 60% that voted in
That's
this,
great.
and the clear winner here is faster underwriting and decisioning.
And that is wonderful. So as we go forward, I think that, it's a little unusual for us to hear that as we go forward. Decisioning and underwriting is one of those where we see really the use cases of research. We see underwriting as our customers are coming through and pulling together different bits of information, reviewing documents, and being able to get to answers more quickly. Still a little bit more human in the loop, and we definitely recommend that from an Experian perspective, because we are making choices and ensuring that pricing is going through. We're monitoring exhaust files from our processes that we're using these generative AI tools, and we're ensuring that we're not creating any disparate impact across the market. But it's good that you guys are focused on a great use case. A lot of the use cases that we see for our customers are in fraud and in marketing, a lot in collections as we go forward, but underwriting is kind of that golden chalice in the middle, that winner's circle as we go forward, and underwriting is really going to be key for us as we see the transformation in the US. Now, what does it mean when we see more and more, and we've talked about this over the past couple months, do we really see that these efficiency gains that are coming to us are leading to some unemployment questions or employment questions across the US? We have seen that increase, and we talk about layoff risk in the top right corner. You see in 2025, we were a little bit higher than we have been. It's been gradually growing. From an AI perspective, in the bottom left corner, we always look at those recent grads. That's generally the jobs that we're seeing from a white collar perspective that are most impacted, because you kind of entry level data moving type of a work that are easier to automate, and certainly with Gen AI that is moving faster. And that means that if you look to the center, we see unemployment, especially for our younger cohorts and those that are younger into the business, having a little bit more difficulty kind of relocating into a new role. But you can see when we see it from a CFO survey, why folks are laying off, it's not necessarily that they're all automating tasks. Again, it's demand uncertainty, and it really depends on the economy at this point, and a little less on AI, since we're just at the tip of the deployment of really usable tools as we go forward. So we're going to continue to watch that. So let's look at employment in general. So we look at job creation across the US. We saw that pick up in January. We're going to see another number come out this Friday that has a wide range from like minus 9,000 up to about 113,000, so a little lower than we saw in January. But again, more leaning toward that positive growth perspective as we go forward in the US. So that's really good. The other thing that we see is a large growth in healthcare. So we think when I talk about my mom or the baby boomers as we go forward, you're going to see that growth in healthcare employment as a segment. And it is one of those that is less impacted by AI as we go forward. And we see that spread of the types of roles that are available in healthcare. It's not just patient care, but it's also all of the back office type of work that's done within the healthcare segment. So a lot of movement in that area as we see it grow. And again, you can see that down in the bottom, white collar versus blue collar kind of shifting around. Now, you will see the government a little bit lower. That's because we did have the shutdown in the end of last year. And so that lowered job creation for really the last half of 2025. So we should see that pick back up as we get into more in the middle of 2026. We'll see this shift happen in job creation segments. Now, when we look at economic growth, on the next slide and we think about consumer health in general, you will see, one of the things that we'll see in 2026 is, and that we saw a little bit of in 2025 is some tax relief. That means tax refunds are going to be a little bit greater. What does that mean back into the American economy as we go forward from a consumer spend? It means about $100 billion coming back in. Now, we do have higher prices. We'll see fuel prices raise a little bit, so you will see some downward pressure on the ability of consumers to spend. But in general, they're pretty good. When we look at outstanding debt overall, it's leveling off in 2025 at a lower level than it's been in quite a while. So managing debt well from a consumer perspective, we see assets, certainly from an equity perspective in some of our higher segments, continuing to grow. We see small business sentiment in the top. Cash flow is still coming. Small businesses still feel like they're getting the cash flow to move forward. So that's really positive. From a consumer sentiment perspective, again, some disconnect as far as what's happening from a debt burden and tax relief. Just seeing what's happening in the globe can cause consumer sentiment to drop a bit. But we are seeing still on some fairly firm footing consumers in general. So let's talk about what we're seeing from an earnings perspective. What's really changed? Our behavior is adjusting. So we talk about this consumer that may be feeling a little weaker, even though their balance sheets are doing just fine. When we look across where consumers are sitting right now, and we see Walmart and TJ Maxx zooming forward, TJ Maxx has really been a winner for 18 quarters and even longer as we go forward. That value-driven consumer has really been there, and it's more about more than just the price that we're seeing. It's the value that consumers are getting from that price. So TJ Maxx is kind of setting themselves up in that way. And we are seeing some basket-driven decisions being made again to those value brands versus name brands as we go forward. That shift has been happening over the last year, so nothing very unusual in that trend continuing through 2026. Now, Costco and those are reporting even better results as we get into this next year, and the expectation is that those will continue to go as value is brought in. And you think from a full fuel price perspective, Costco is going to get a bit of a lift there too, because if you're shopping at Costco, that's where a lot of the lower prices are in fuel. As you're driving around, my wife says, hey, if you're going by Costco or Sam's, jump in there and get your fuel. Don't drive to your normal places because the price is going to be higher. I think we'll see some of that directional shift in some of these value-driven companies as they go forward to try to bring that value to customers. Now, when we look at from a housing perspective, Home Depot and Lowe's still challenged with big projects as the housing market still impacted by higher rates and slower builds, slower starts. Inventory still maintaining a pretty low volume because of affordability in the housing market as we go forward. You see smaller projects still moving forward. Home Depot and Lowe's are still leaning into their pro programs. So, handymen and those that are doing small projects for homeowners and small businesses are doing pretty well this year. And we'll see that segment of those businesses kind of pick up, but not really big projects. A lot of those were done closer to the pandemic. Now it's a lot of maintenance projects that are happening for folks in their houses. So even though they'll do well, they won't see big growth probably over the 2026 as we move forward. So when we think about all this, how are consumers doing if they're feeling pretty well? Are their delinquency rates going up? What could be causing that? You can see from an income and spending perspective in the U.S., we see some softening. And you'll see that from the comparison of real disposable income to real consumer spending on the far right-hand side of your screen. What has been interesting is that transition from 2024 to 2025, we saw that inflection point where incomes have not been growing as fast as people have been spending. And remember, people have a lot of equity built up in the market, so some cushion there. Their savings rates are a little bit higher. Those will come down a little bit more. So that's putting a little bit more pressure on spend in general from a consumer perspective. When you have that thinning out of consumer balance sheets, you will see delinquencies start to rise, and we'll see that in the far left-hand side. And 60-day delinquencies, a lot of credit card companies use 60 days kind of the measure, and we see that across. You'll see that spike in the dotted line, and all 60 days past due. That was our student loan. We saw that kind of pick up. When that really hit consumers' credit profiles, we see and kind of solidified that it was going to be back into the repayment phase. We saw student loans begin to be repaid again, brought to current, or put into more of a debt consolidation packages as they move forward. So we saw those delinquencies start to come down from that spike that we saw in early 2025. Delinquencies in general are coming up slowly, but they are coming up. When you look at wage growth, I think about my 19, 20-year-old as they got jobs in 2022, 2023, they were making big money. And for them, instead of a $9, $7 an hour job, you were up at $15, $16 an hour. That wage growth has slowed much faster than we see from a white collar perspective in the third and fourth quartiles, but you do still see that coming down. And that's as we see labor kind of thin out and soften a bit. We are seeing some of that wage pressure lighten a bit. And so that's, again, going to the right, far right, we'll see those incomes slow. And when those incomes slow, consumers look at spending to continue to slow a little bit more. So that downward pressure is definitely there. And we think in the next slide, when we look at lenders, and you all are in this bucket, we have seen it, lenders not tightening. And when we look at the SLOOS report that came out in January, we continue to see that trend, both in small business and consumer lending. The pressure is kind of off. Not as many lenders are looking at tightening rates as we go forward. Delinquency levels are coming up slowly, so it's not really there. You do see the demand picking up down in the bottom right-hand corner for loans. So the demand is there, and it's increasing a bit, not spiking, but increasing. And lenders are looking at this next year with the strong balance sheets in general to keep those lending windows open. So when we look at what's happening from a Federal Reserve perspective and inflation perspective, again, we're seeing it hovering around from a CPI perspective around 2.4%, a CPE perspective. When we look at the cost of goods going forward, we see that ticking up to almost 3%. I think 3%, around that 2.8 to 3% is probably where we'll sit for a little while. We really want the 10-year to come down, but over the past couple of days, that's taking a little pressure hit, as we go forward. So as we look at consumer prices and we see that kind of proxy in the 10-year, and we look at where interest rates will settle, they're going to stick with us for a little while. When we look at the likelihood of the Fed to cut, inflation going up, unemployment fairly stable at this point. We don't see the Fed, it's kind of hovering around. It was 2 to 3 last week. This week, it's around 2 times in 2026 that we're likely to see a Federal Reserve cut. So a little more tempered activity as we get into this next year. The Fed is looking again at the data, and even as much as the administration would like it to take some action, and we'd like to see generally rates come down to refinance and to look at ways to free up capital, I don't think we're going to see that at least for a little while as we get out of spring before we see some of those cuts, even a possibility. All right. So when we look at growth in the U.S., so let's say that we see that, we look at GDP growth, the expectations for this year for 2026 back in the third quarter were pretty high. We were aiming at, high 2s, mid 3s for growth as we go forward. What we're seeing is a little bit of a pullback. We saw that in the fourth quarter. Remember, we had a government shutdown during this time, so government spending was limited. And so that really put some impact on our GP numbers in the fourth quarter. And the expectation is that those will bump back up. We'll see a little bit of a lift here from the big, beautiful bill as we go forward with some government spending. So almost a percentage point here coming out in 2026. That should certainly help. And from a market perspective, equities perspective, we have seen some drop-offs here in the last 2 days, 3 days, with what we're seeing in, certainly in the Gulf. And so we could see some pullbacks here of 2 to 3%. We'll look at how quickly the conflict either resolves itself or security within the region and again within the Strait of Hormuz opens up again for shipping and air freight to continue through the region. That'll help to bring again the market back up. But what we're seeing is pretty stable on the fundamentals underneath. The challenge here is perception from market and investors, and so we'll continue to watch that as we go forward because that could again have some impact on markets and, as we go forward. And we're seeing that really more impacted in markets in Europe and Asia and certainly in Europe as they're more energy dependent on that region. So any slowdown there can cause some challenges. Here in the US, I don't think we'll see as much from that type of impact, but again, that can impact here markets. Certainly the Russell 3000 that looks at small caps may see a little bit more of an impact as we go forward because of some of these global challenges that will impact U.S. markets. But from an AI perspective, which is a big part of the S&P 500, probably not as much of an impact as we get into the next couple months. So let's look at what small businesses are doing as we kind of close out our macro view section this morning. What you can see it's really a comparison of what we see from a sentiment perspective. That's that gray background trend that you're seeing in the left-hand chart. And then in front of that is the NFIB. Look for businesses to continue to expand. And you can see it's at an elevated level at this point. Really, it's the affordability that we see through AI. And I talked about my own business here. That definitely has an impact on small business looking to grow because they can do some of the processes that they generally had to outsource, do it a little bit more affordably now. And there, a lot of the businesses that are opening are retail online businesses. So you think of that omni-channel reach across markets. So not only being able to sell locally here to my local market, but also being able to put my products online and ship them all over the world. That makes a big difference from a small business perspective in that addressable market that they have to go after. And tools just become more and more available to small businesses owners as they go forward. So less impact on them. They can get back to what they like to do, which for me is baking cookies and pies in our shop instead of a lot of paperwork. So we look at really lessening a lot of that labor that's over the top that, from a small business owner, the labor costs that I would have in general are easing a bit as we go forward. So that gives me a little bit more leverage as I get into this next year to be able to look at growth for my business versus worrying about the constraints that might have been there 12 or 24 months ago. So really seeing some positive perspective as we look into the next year. Now, Marsha, I'm going to pass this over to you because I want you to talk about what we're really seeing in the data from an Experian perspective and how some of these macro trends really translate into what we're seeing from a small business performance perspective.
Thanks, Brodie, and thanks for that great insight into the economic environment as well as some of the consumer behaviors. Gary, if we go on to the next slide, this shows our Experian Small Business Index, which, again, great insights from Brodie. This is an index that we built here at Experian to kind of bring that holistic view of how businesses are performing. It assesses the financial health and small business of the small business owners as well as the businesses across the United States. And it combines both credit variables from the personal perspective of those owners and the commercial side. If you have your phone in front of you, you can pull up that QR code and sign up to get this on a monthly basis from us. And what we've seen here over time is that a range from about 40 to 60 points indicates kind of the normal conditions. And so we were a little bit below that late last year in 2025. driven by some uncertainty in the environment. We know the tariffs impacted the cost of goods. We know that the government shutdown, not only, as Brodie mentioned earlier, the government wasn't spending the money, but think about all those employees for a record long 43-day shutdown, all those government employees who weren't getting paid, even if many of them were still working, they weren't getting paid, so they didn't have the money to spend. So we saw some downturn late in 2025 below our kind of normal range, but we've picked up and back into that range, and we see a solid base to go forward from here, and looking forward to the outlook in 2026. So if we go to the next slide. One of the key indicators driving small businesses is the supply chain. Nobody really ever talked about supply chain until COVID-19 hit and there was major disruptions. So you see in the middle of the LMI chart where it was below that 50 range, where below 50 means contraction of our logistics, moving products around and getting them from place to place. Over 50 means it's expanding. We now, since COVID, have had a couple of years of expansion, which is great news, no longer contracting. However, that growth in the expansion, you see that curved line, which is the trend line, we are trending to less growth. So still expanding, but less growth. And what's really driving that? We see on the right-hand side that two of the key factors that are driving it are lower inventories. Businesses are keeping lower inventories on hand, and signs of slowing in warehousing. Obviously, if you have less inventories, you're not using your warehouses as much to hold those inventories. So a couple of the underlying factors for the LMI index are slowing, and not only just slowing growth, but you see that they have been dipping below that 50 point. So not only are they slowing growth, they're actually starting in a couple of months here, starting to contract. And so we'll see how that goes going forward. And a lot of what drives this, as we go on to the next slide, some of the movement of goods really relies on fuel prices. And this chart we pulled together before the weekend, where the whole oil perspective may have shifted in the last 3 to 4 days. But even before this weekend and the conflict in the Middle East that erupted, crude oil prices early in 2026 have been trending upward. They had been on the lower end of, the lowest they've been in several years, about 4 or 5 years, coming out of the height after the pandemic, when inflation, especially energy inflation, was extremely high, had been trending pretty steadily down for the last 4 to 5 years, and 2026 started that increase. And what happens when crude oil goes up is we start seeing that at the pump. And on the right-hand side, that inset graph, that's the average gas price per gallon. You can just see it over the from a week ago and from a month ago, trending upward. Now, gas prices right now are still below about a year ago, but we're getting close to that. So, with this shock to the system and the Middle East conflict that is occurring right now, Brodie mentioned the Strait of Hormuz. So many people may not have even heard of that, but that's where a lot of our ships go through to provide goods and oil across the world, not just to the United States. And approximately 20% of global oil supplies go through that strait every day. And right now that strait is closed. And so with 20% of oil stopped in its tracks, not getting to where the demand is needed, we already are seeing it in the last day or two, where crude oil prices are spiking up. So this is really going to depend on how long the Middle East conflict that's occurring right now goes on, because the longer that it goes on, the longer those ships will not be sailing, and the longer that oil and other goods and products aren't getting to where they need to get, or people are demanding the goods. So we will be keeping a close eye on this, and this will be, whatever happens, whether it's quick or long, this will impact the supply chain and most likely prices and inflation. So again, keeping a close eye on this. If we go on to the next slide, aside from this shock that we're seeing over the last 3-4 days, the business environment has been very strong, stable, great outlooks, to the point where we are opening in the United States, record numbers of new businesses are filing to open. So pre-pandemic, the average was approximately 300,000 new businesses opening each month. Then after the pandemic for several years, the average, we got a new normal that was elevated, opening at about 440,000 a month, so almost a 50% increase from pre-pandemic. In the fourth quarter of 2025 and into January of 2026, we're now seeing an average of about 511,000 new businesses every single month. So we're elevated up and above the new normal that we saw for the last couple of years, and more businesses are opening. What is really fascinating to me here is that line you see across the chart on the left, that is going from about 15% back in 2018, cut in almost half down to 7% now. And that's the number of businesses that have employees that are being paid. So the inverse of that means that the number of sole proprietors is growing exponentially. So back in 2019, we only had about 85% of, not only, but 85% of new businesses opening didn't have planned wages, meaning 85% were sole proprietors. Now we're seeing 93% of new businesses opening sole proprietors. So it's really interesting that a lot of these maybe are small businesses on the side. You have a job like Brodie mentioned. He has a regular job here at Experian, but he's opened this pie shop on the side. So a lot of those kind of things going on. I think people, COVID is 5 years behind us, but it still has impacts on how we live, how we work. I saw a report a couple of weeks ago where we're back down to only about 8% of all new job postings are remote, where we had been 40 to 50% a couple of years ago, and people may not want to go back to the offices, so they're changing their mind, saying, I'm going to open my own business. And there's a lot of these factors that we think, okay, COVID is in the rearview mirror, but it still has impacts on our life choices, and how we operate and think about going forward. So a lot of these sole proprietors popping up. And that also is why it's so important in our small business index that we're not just looking at the commercial credit, we're looking at that business owner's credit and combining it so that we have a greater picture of really how that business might fare in the future. And with all of these new businesses opening, it's not a surprise that commercial credit, the new accounts that are opening, a much larger portion of them is going to these newer, younger businesses than ever before. So you can see, I know that the chart on the right could be a little bit of an eyesore, but the darker bar towards the top, the dark blue, that is businesses that are over 10 years in business. And you can see they used to make up about 40% of all credit, and now they're only making up in the 20-25% range of the new credit coming out. So it's a big shift of who lenders are lending to, really just because of the nature of who is seeking that credit, as there's so many new businesses coming into the marketplace. And so with that, if we go to the next slide, we give a little overview of how those businesses are using the credit that they are getting and what types of credit they are receiving. And two of the main products we see on the commercial side are credit cards, which is on the left, and the installment loans on the right. And as a proportion of new accounts, there are fewer credit cards being issued and a shift more towards installment loans being issued. And the inverse is true, that the cards are getting higher lines assigned and the installment loans are getting lower loan amounts over the last couple of years. Just interesting dynamic here, where installment loans, even though they're becoming a larger portion of new commercial account openings, most lenders that we talk to, installment loans have a lot more due diligence, and they are not just using one score. They may be looking at multiple aspects of the business to really decide. They're giving more money away, over, averaging about 150 to 170,000 over the last couple of years. There's a lot of due diligence that goes in there, but as they're giving more, and we saw that there's maybe a little bit of less tightening on criteria, those lines are coming down a bit on the installment loan side. So an interesting dynamic there. More people or more businesses are getting those installment loans, but at a lower amount. On the flip side, the cards are probably tightening a little bit. Fewer are getting them, and so the ones that are getting them are getting the higher lines compared to a year or two ago. So interesting dynamic here on the credit side, and we always keep monitoring these, because how the businesses are using the credit is really important to us, important to all of you, and how the businesses will fare going forward. If we move forward, one thing that we've been keeping an eye on is bankruptcies across the commercial space. And we saw a lot of forbearance and forgiveness of loans in the COVID period. We saw businesses receiving financial aid with the PPP loans and stuff. So bankruptcies were depressed for a couple of years, and they have come back kind of to the norm, pre-pandemic norm. And they've actually, in the third quarter of 2025, hit a 10-year high, and that rebounded back towards where, in the range where they were, but it's at a 10-year high for business bankruptcies filed. And when we dig into that, the interesting thing here is that increase has been driven by the Chapter 11, and not just standard Chapter 11 filings, but the newly created Subchapter 5 filings. This was enacted back in 2020 or late 2019, and business the Subchapter 5 filings are specifically for smaller businesses to restructure. So the Chapter 11 restructuring has been in effect for years and years and years, and it's geared more towards bigger businesses like an Experian, which I hope we don't have to ever declare bankruptcy and go into a restructuring. But if we did, it's for those kind of big businesses where there are a lot of filing fees, court proceedings. You put in a panel that's appointed to review everything, and again, it's for those bigger companies, the Chapter 11. And smaller companies, if they wanted to restructure, if they couldn't afford that barrier to entry into a Chapter 11, they might just close, not really declare bankruptcy, but not restructure. And the Subchapter 5 allows smaller businesses at a lower cost, fewer fees. They don't have to establish that panel that votes. There's a lot fewer barriers to do a subchapter 5 filing, and so we see that those subchapter 5 have doubled in volume since just 5 years ago when they were created or established, introduced into the market. So what we see that that is pretty much like the difference in what's driving bankruptcies overall up. And if you look at the bottom, what we see is that the younger businesses, now remember, we have a lot of new businesses, not just younger, but on this page, it's smaller businesses, 1 to 4 employees. And that's really what subchapter 5 is geared towards. But we see that those smaller businesses with very few employees are the ones, especially over the last couple of years, that have been filing bankruptcy more and more often. So something to keep in mind as you're lending out there is that while bankruptcies are up, they're coming from a specific, small business portfolio. And if we go to the next slide, what's even more interesting is that commercial delinquencies are not really what's driving the bankruptcies. To me, it seems like it's the opportunity that subchapter 5 has provided businesses to restructure that could never really, again, afford to restructure in the past. It's the opportunity to do it now that they are doing it, and a little bit less about major trends in delinquencies that are driving higher bankruptcies. Because if you look at all of these charts, which really just have commercial delinquencies by different cuts, we don't see increasing, trending upward like we saw on the consumer side. Delinquencies have been fairly stable on the commercial side. One thing to point out on the upper right hand corner, where we look at it by region, the 2 regions that we do see a little bit of an increase and higher than other regions are South and Southwest. And if you recall, when I was showing you a few slides back, the new businesses that are opening at an elevated level, a vast majority of that growth comes from the southern region, where South and Southwest, where a lot of new businesses are opening. So those younger, newer businesses, smaller businesses are having higher delinquency rates. And so it's an interesting, almost contradiction to the bankruptcy view that they're growing, but we don't see across the board delinquencies really in a troubling state at all. So as I mentioned, I think it's really more about the opportunity for smaller businesses to have this restructuring option. And so if we go, actually, I think we have a poll here, Gary.
We certainly do. We certainly do.
We're going to start wrapping up the small business portion of this, and we only have a few minutes left anyway, but in the first quarter, most small business borrowers are actively trying to grow. Do you agree or disagree? We'd like to hear your view as we look forward after we've kind of looked back at all of the trends. We want to know going forward what you're thinking if small businesses are looking to grow or maybe just stay status quo. How are we doing on the poll, Gary?
We've got about just over 52% voted. We'll get a few more responses here. Of course, we're polling people at a very, very uncertain time, so we have to weigh that with recent news.
Yeah. So do we think this will be about 50-50 with the uncertainty, or?
No, I think we're going to be okay. I'm going to go ahead and close it. We got 60% voted here, and let me show you. I think we've got some optimism here.
So about 56% are looking to grow. Great. That's we hope that's the environment, and if we go to the next slide, we look at the survey from the NFIB, which is a survey of small businesses, And the outlook looks pretty much in line with our survey, where respondents are saying it's a good time to expand much more often than they have been over the last few years, and that it's a good opportunity, a good time to expand. So we are in line with our survey. And on the right-hand side, there are some headwinds. There are probably more headwinds now over the last week than what was surveyed last month, but taxes, inflation, of course, the quality of labor out there as people are trying to hire, and then the cost of insurance, and probably the cost of many things, and affordability out there is kind of a theme we hear all the time. So glad to see that survey is in line with our polling today. And as we wrap up on the final slide, just to recap some of the headlines and themes that we're seeing in Brodie's segment, in the economic environment, we see that there's solid growth, solid economic momentum. We're happy to see that while there's a few headwinds, there continues to be solid economic footing. Labor market, while it is solid, maybe halting a little bit, stuck in neutral. Easing inflation, yet persistent. We see it still in the 2.5% range, higher than we'd like, but not as high as it was a couple of years ago. Consumer spending is still strong, yet slowing. So solid economic environment, few headwinds that we're going to be watching. They could go either way. And on the small business landscape, we see entrepreneurship going strong. So many new businesses opening, continuing to open. Every time it ticks down a tiny bit, I say, oh, now we're going to start that downward trend, goes right back up. So more and more new businesses opening. Right now, as of Friday, when we put these, the supply chain is solid. Uncertainty there, so we'll watch that. Bankruptcies up, but delinquencies are steady. And businesses seem to be optimistic for 2026, which is a great sign that they will invest and continue to grow. And then, of course, across the bottom, AI investment and adoption. That's across both the economy, impacting almost everything on the left-hand side and impacting almost everything on the right side. How it will be adopted into our businesses, into our lending practices, will really impact the economy too, and vice versa. So it's a lot of a wait and see, and it'll be an interesting next quarter when we regroup again. So Gary, I know we're just about out of time, but if there was a quick question that we wanted to take.
Well, there was one question from Mary. I think it's a good one around business creation. A lot of the new businesses that we're seeing start up. What industries, Mary asked, what industries are all of these new businesses in primarily?
Yeah, it's interesting. The ones that are leading the pack are professional services and retail are two of the ones that have seen the most growth. And you think retail, why, a lot of stores close, but I believe that it's more of the e-commerce. So maybe, hey, I make jewelry.
That's right.
Jewelry in my,
it's definitely online.
Right, I make jewelry in my basement when I'm free, and I just set up an online store and send it out to people who want it. So we see those are the two of the biggest growth industries sectors are professional services and retail.
Excellent. Okay, folks, we're going to have to leave it there for now. We'll be back next quarter with a new review. I'd like to thank everyone for attending today's review. If you would like to dive deeper, of course, check out the Commercial Insights Hub for more great insights on small business credit performance. You'll see Commercial Pulse there every 2 weeks. Marsha, she's doing it. She's a heavy hitter here every 2 weeks with an economic report on small business, and we back that up with some video resources. Also the index, stay tuned to that on a monthly basis. We'll see how that shakes out, and then we'll be back here next quarter for the next economic review. Find us at Experian.com. /commercial. And we'd like to thank everybody for attending today, and have a good day. We'll see you next time.